everybody for joining. I know you all registered for this because we're going to be talking about weathering the storm. You've all seen the content about what's going on in the market, and we want to be on the front lines of kind of talking about how to navigate that from a finance perspective. And so before we get started, really just want to go through the basics. We've been to a webinar before, you kind of know what these look like. You've been automatically muted, sessions being recorded, and there's a Q&A function that you can use that we'll be paying attention to throughout. But for the most part, we'll take like 10, 15 minutes at the end to go through them. And as always, if we don't get to your question, we'll be sure to reach out after the fact to give you a personalized answer, make sure we get to everything that we can. But just really excited to have everyone here, Ross, Jervis, and Bij. Before I introduce them, I want to introduce myself. My name is Joe Michalowski. I run content at Mosaic. You're not really here to hear from me. I'm just here to moderate, keep on the guardrails, and make sure we keep everybody on time, but really just facilitating this conversation between the great panel that we have. And so I want to have them give brief introductions. So I'll pass it over to Ross, you first. I want to give everyone like the 1-2 minute background on who you are and what you work on.
Great, thanks, Joe. Thanks everybody for being here. My name is Ross Fabini, and I'm based here in the Bay Area. I run a firm called XYZ Venture Capital, which I started in 2017. We're about $500 million under management. And so what that means is that we're going and investing mostly in early stage businesses, primarily in the fintech and enterprise space. So excited when we can talk about the intersection of fintech and enterprise, which is tools for CFOs and planning tools in specific. It also means that a lot of my job these days is talking to our 84 portfolio companies about planning and how to weather these current capital markets and come out stronger at the other end. So excited to be here and in this discussion.
Awesome. Thanks so much, Ross. Bringing that VC perspective is going to be really important here. So love to have you here. Jervis, I'll throw it to you. Want to do your intro?
Thanks, Joe. I'm Jervis Williams, CFO of Legion, and I run finance, HR, and IT at Legion. We are a portfolio company of XYZ, so I am a sibling of Mosaic, and we are Legion is in the we are a SaaS startup in the workforce management space.
Cool, Jervis. Excited to have you here. We've had Jervis on a webinar before. He always does a great job, so this will be great. Part 2. Bij, throw it to you last. Do your intro.
Joe, thanks so much for having me today. I'm Bij Molemi, the CEO here at Mosaic. Spent my entire career in finance. So started down here in San Diego at Qualcomm, spent 6 years building and leading the finance function at Palantir. Then at another XYZ portfolio company, actually, Piazza. And then for the last 3 years here at Mosaic.
Awesome. Well, great to have all three of you. Really excited. Want to jump here and just go straight into an agenda. We've spent these first 5 minutes doing topic intro, so you know that part. But really wanted to explain, we're breaking this out into like 4 key sections. There's this quote I really liked from Andreessen in one of the articles that they put out when, this whole economic storm happened. And it's that, startup founders or entrepreneurs aren't really looking for like platitudes, the high levels, like things that you need to be doing. They really want actionable advice and deeper insight into, how to get through the other side and come out stronger. And so that's really what we want to do today, is give you some of that insight and bring together some people that can do that. So we'll start off talking about like what the current market circumstances look like. We'll talk about what operators should be looking at a high level, dive into metrics that matter most. Cannot have a finance webinar without talking about metrics. And we'll kind of wrap up the main sections with some scenario planning discussion, and then we'll get to our Q&A and wrap up. So that's where we're going today. So we'll jump right into it and we'll get into topic 1. It's really, how bad is this economic storm going to be? And we are very fortunate to have somebody that is on the front lines of investing through one of these storms and, others in the past. And so Ross, I'll throw it to you first. I just want to get your perspective on what the current market looks like and how circumstances have impacted how you advise your portfolio companies.
Yeah, so maybe there are 3 different things to say. The first is there's like how it feels about like for a human. So when your 401k today is going down 3%, and yesterday was going up 4%, if not 13%. There's just volatility in the market. That said, what we see is, well, first we have to understand where we're coming from. For the vast majority of venture scale companies, what we had going on in the last few years was really just, an increase in multiples. What we saw for companies, whether we were investing day one or round C and D, is everybody's building a $10 billion business because every multiple is 50x. And so the big correction that's coming right now is really a multiples based correction, generally speaking. We're not yet, we might change, see huge budget contraction. We are seeing some layoffs. We're seeing, supply chains really affecting some hardware businesses. And that, but those tumults are really on the side. The core thing that's going on from a capital perspective is multiple compressions coming in. So that's most visible now as people are planning out their businesses. And so the last thing I would say, and this is having gone through the dot-com bust in 2008, like the first thing is like the world is not actually ending. We do not have structural issues affecting the way that banks operate, thinking whole countries are going to go, out of business. But the multiple compression means that all of our operators, everyone on this call, has to think much more carefully about their business, because investments that are being made now have to create the evidence points that mean you're able to raise your next round of funding, perform in the next quarter, et cetera. So it's a much more careful set of investments that we can talk about. And so that's the hard work that's going on. I would say that the last thing is that there's this trope in venture that like the best companies are built in bad times. One of the things that we see right now, including my fellow panelists, is companies that are running the best right now, that do their best work, end up not only raising more amount of capital, going public, whatever, but they end up as the Atlassians with a go-to-market advantage, with the ServiceNow, with the customer retention advantage in the future. They end up in these very, very strong positions. So it's hard work that'll hopefully pay off in the long term.
Yeah, it's a really great point. I love, the chart here, I think really speaks to that multiples compression that you're talking about. I know, Jervis, we talked about this in prep, is that's something that's really top of mind for you at Legion. So, if Ross is talking about how this is the big focus from a market perspective, can you talk a little bit about how your work at Legion is being impacted by kind of this multiple compression idea?
Yeah, so that's a very good point. And for us, multiple compression really impacts how we look at timing of our next round of fundraising, because ultimately evaluations are based on a multiple of revenue. And so for us, that means we want to have maximum revenue before we go out to market looking for funds. And so it's probably delayed our plans in terms of when we're going to go out for fundraising, to make sure that we have big deals that are in the pipeline, that they come through first. And but fortunately, we have a very strong business from a fundamental standpoint, and we just did a last round just last year, and we are very focused on operation at this point. But in terms of multiple compression, it really impacts our fundraising timing.
Gotcha. I think it makes a ton of sense, and I know I'd love to ask Beej the same question, but I think if I did, he'd be like, just yes, that is obviously kind of where we're at too. I've heard it from him a lot. So Beej, I'd love to get your idea of how you, from the CEO perspective, are working with someone like Ross or your other investors to manage your way through the situation that Ross kind of teed up. Are there any tidbits you have about kind of getting the most out of your investors at a time like this?
Yeah, definitely. Feel really lucky to have the investors that we do, like Ross, around the table, spending time connecting with him more frequently, talking to our other investors as well, really just trying to keep a pulse on the market and get a sense of how things are changing. I think to answer the question on the slide here, Joe, how bad is the storm going to be? We can kind of sit here hypothetically. No one really knows, and so I think we tend to agree with Jervis here. Really, it's all around optionality for your business. So not knowing whether the multiples are going to be compressed for 12, 18, 24 months. What are the things that you can start to do now to make sure that when you do not need to go out to fundraise, you're doing it from an advantageous position versus doing it kind of more reactive or because you need the money, which means it's going to be dilutive or potentially not the best round for the business.
Makes a ton of sense. I think, to roll this back to where I started, which is like people aren't looking for platitudes right now. I think it's why this section might be the shortest one that we do on this webinar, is because the people here, if you're attending, is like you're a finance leader, you're like a startup leader, and you really need to know, like, great, I don't have an answer to how bad it's going to be, and maybe I wish I did, but the reality is, to Ross's point, get that excellency in place now, figure out how you're going to navigate it and get to the next step. And so it's why I want to jump now to kind of our second point, which is really like what operators should focus on to weather this storm. And Bij, I'll stay with you because it really follows up to that optionality point and like having that calculus down. But every company is different. Like how on a higher level has this situation impacted the strategic plans of Mosaic, and how are you looking at kind of high level operational focuses to get through the other side?
Yeah, definitely. So I'd for sure love to get Ross's take, given he's got the investor lens on it. But I think kind of the sentiment that I've been hearing in the market is the lens has changed, right? It used to be burn is less of a factor. It's more around what is growth and what's that growth multiple. So maybe we were optimizing on growth, and the calculus has now changed to where fundamentals are more important, and runway and conserving expenses may actually be better for your business to raise on your terms than growing a little bit more. So I think for us, when I say maintaining optionality, what that means is what are the levers that you can start to pull to maximize your runway. And you don't really want to be over your skis, right? If you're running against 12 months of runway, 9 months in, you're not hitting your growth plan, there's not a lot of options. So what can you do now that will actually give you more options if things are not going as planned, if the downturn lasts longer than expected, et cetera?
And also just to join in on that point. So we are focusing on our burn and our runway, but at the same time, so we have a certain capacity in place from a go-to-market perspective, from an engineering perspective. So it's really about how do we kind of maximize our operational efficiency and really leverage the people. And we're a software company, so how do we leverage the people that we have in place now? And the great part about being in finance is I have all the data. I mean, I can see the SaaS metrics, I see my costs, I see the cash going in the door, I see who's working on what, I see how many, what releases are coming out, how many people did it take to work on and getting those releases out. And so there's tons of data that we can use from an analytical standpoint. And of course, I have my Mosaic dashboard that allows me to go in and see some of those operational metrics.
Jumping in on this, especially knowing that there's a great number of finance people on the call, I think the first thing is getting out of magical thinking. I think the finance teams here probably have to do some education in cases with their CEOs and in leadership teams, is realizing while the world hasn't ended, it's changed pretty dramatically. And so the first thing is I think is not assuming it's going to change. It might. The world, we want wars to end, we want inflation to improve, we want multiples to track up as a result. The markets currently just aren't pricing in growth, essentially. And so having people understand that and then operate as if that is the current world is the right thing to do is probably a real important transition. And I suspect a lot of people here are having those calls. And as Jervis, you said, operating with math and saying, hey, look at this math, we need to do things. And I would say the vast majority of the people that we interact with get that. Occasionally we'll talk to someone and be like, well, we'll just call one of the people that we passed on the last round and they'll do this at 4X mark. And I'm like, oh sir, the world has changed. And then the one thing that I would say, just in Joe, in your spirit of being prescriptive, we see very different things based on stages of companies. The companies that are, we have late stage companies that are profitable and are scaling. And to Bij's comment, their plans have changed. They're not going to go IPO in this market. And we've seen people there really focus on dollar retention, on creating new products that are being cross-sold, and really and making sure coming out of this, they're in a stronger place with their existing customer set, and maybe expanding out their TAM. The second set of people is folks that are post-market fit. So these are companies, it's probably the majority, happily, of our business that are in market. They have a product that has an aggressive adoption because of that post-market fit. Here's where people are probably doing the most calculus. And what we've said to those folks is figure out right now, given the changing landscape, what are the numbers we need to hit? What is that plan to accomplish that we can confidently raise around, as Bij said, from the people that you want, the terms you want, and figuring out what those goals, and that's a part of the process. Now those goals have shifted. Then what is the planning spend? Get open the Mosaic dashboard, start walking through and saying, what are we going to do in order to get there in this timeline? And then our prescription is then when you get there, have a year of burn from that point, ideally, not more. And so what that's causing people to do, in some cases, they're actually burning more money because they'd say, well, I'd rather hire the reps now so they'll be full performing next year and I can hit it, or I'll hire a BD person now because we need more leads. And then in other cases, it's no, we're going to go slower, have higher quality revenue. We have a phenomenal company that coming out of last year, great numbers, was going to grow 12x this year. Instead is dialing back and is going to grow about 7x, still phenomenal numbers, but on much higher quality revenue, higher margin. They're spending more time taking some service stuff out. And I think it's going to make the company stronger. So again, planning is the core part of this, and finance is the core voice in the room. And then lastly, just for completeness, our pre product fit companies, they're doing the same exercise, in essence, looking at their dollars and saying, okay, what things do I need to hit to get there? And there are lots of unknowns and assumptions in there, but it's very carefully planning where I'm going to spend capital to answer the questions I need to in the next round. I would say in most cases, people go through that analysis, and the budget tightening means that they hire a little slower. And in many cases, they're riffing maybe 10%, a couple of people, which is a sad thing, but it's part of a good tightening process. So it varies a lot based on stage, but it's all like, where are we going, and then what's the planning against it?
Yeah, totally. I think, go ahead, Jerv.
Yeah, Ross, and you mentioned a great point, and that is, I mentioned earlier, we're focused on cash burn, but we are still hyper focused on growth. So we haven't taken our eyeball off that. We haven't, scaled back. But what it means is, like, from a sales perspective, rather than hiring 50 more account execs, well, let's focus on account execs we have on board. Are they productive? Are there enough deals coming to the pipeline? What's our go-to-market activity? And so, we are really kind of accelerating our go-to-market in terms of pipeline building to make sure that the reps that we have in place today are productive and productive, sooner than because in the plan we're very conservative. So if we can get them productive even faster than what's in the plan, that will accelerate our growth. And so I think we just have to be smart about how we grow. Rather than just throwing bodies at the number, we're throwing marketing dollars and also our inside sales team. We've ramped things up there to make sure that they are really getting deals into the pipeline as well.
Yeah, I'd agree with all that. I think, Jervis, based on how we're thinking about things, as well as some of our customers as well, I think to your point, right, you have bodies at the company. How do you make sure that you're getting more leverage out of them before you're thinking about those next set of hires? So trying to increase that efficiency is super key for everyone that I've been speaking to.
I want to get a little bit tactical about this. I got dog barking in the background, sorry everybody. But I know Bij, we've been talking about this topic for a while, and there was a framework you had because to Ross's point, every company is different. It depends on scale and size. But I really liked this framework that you had for kind of looking at these opportunities to map out where you can extend your runway, how you can become more operationally efficient. I was wondering if you could just explain kind of what this grid looks like and what these kind of 3 areas of spend are, because I think it really speaks to a lot of what all of you are saying right now.
Yeah, definitely. So thanks for putting up the graphic here. The way that I've thought about this in the past is let's pull your spend down. Let's go ahead, map things out in terms of where are you spending the most, where are you spending the least? And then kind of the other axis here is what's the impact to the business? So where you really want to be is kind of this top right quadrant. Where can you save the most? Where maybe there's fat to trim or things that are low impacts to the business if you have to make cuts. And then obviously the things that probably wouldn't make sense to focus on is that bottom left quadrant where the burn impact is minimal, but the tax on the business is quite high. So this is kind of the matrix that I've used in the past to start to figure out low-hanging fruit. And again, depending on kind of where you are, each business is going to be different. You may have to move beyond that top right quadrant, but this is just kind of one framework that I've used in the past to map out where you might be able to find some efficiency.
And just to add to, I love this matrix. And so just to put some real savings. So like for us, we're focused on non-customer travel. And we're totally virtual as a company. We have no office. And so over the past few months, we had a few in-person meetings where we'd have certain functions get together in a geography. But now we're going to pause that for a while. And we're going to continue just to stay virtual and not meet in person. But in terms of our customers, that's not going to change. Another area are apps. I just recently took over IT and learned that we have over 80 apps across our company. 80 apps and like 200 people. So it's almost, and that ratio is just way too high. So we're literally going through with every manager, app by app, like justify this app. Is it redundant? Is it really needed? Is it even being used? Because sometimes people just get an app and only need it, to test something out, and we're still paying a monthly or annual fee. And then the other area are contractors. And so I'm having my managers justify every contractor. And not to say that they shouldn't have the contractor, but the beauty of having a contract workforce is you can be flexible. And can we reduce that contractor by 25% and still not impact the business? So those are kind of 3 areas we're looking at: travel, apps, and contractors.
Yeah, I totally agree. And I'd also like to add in one thing here, which is, as a former finance practitioner, it's really easy to look at the numbers without context and just say, hey, we got to go trim here. But it's really important here to not just look at the data, but also see the business side of the problem and make sure that you're talking to your business partners with empathy. Oftentimes there is going to be more of a story behind the numbers, and something that may feel like low-hanging fruit, there may be a hidden cost to the business to where it may not make sense. But I love kind of going through applications, those Zoom licenses, all that sort of stuff really starts to add up quickly, for sure, Jarvis.
Right. Yeah, that's a great word, the empathy. Yes.
I also think that strategic awareness, I like this graph a lot relative to then how it changes over time. We'll just choose examples. Like we have a company that was trying to do some stuff international, and we've stepped back from doing that. Not the opportunity isn't there, because it fit with that top right. It was both a big savings to not do that because we're building out a pretty large office in London, and it was low impact near term to the business, because now in that example, it is also calculating that for our current revenue needs and perception of the business, this was a nice to have. Like, it's a global story. Yeah, we're going to give that up to save that money. And in contrast, that same company, many companies have been still spending a lot into product development, not just because that's important, you're going to build things, but because next year we're trying to take the company dramatically up market. And so you need that investment into that big spend in order to be able to move the company forward in the back half of next year. So that's strategic, to your point of like, what's the why? And some of that is the individual conversation with, I imagine, with executives, with empathy and understanding. And some of it is like, again, this framework of like, what are we spending in what order? When do we want that revenue to show up? And again, we're living in a time where it's not just like spend less, survive. It's spend smart, spend in these ways that you show up and the business is stronger as a result. And which by the way is goddamn hard, because nobody wants to lose the people. And the first person you're going to and saying, hey, I want you to do more with your customer success team, but I'm going to take 2 of your low performers out, and you can't have people back until Q2. Like that's the tough human part. They don't want to do that, but like I think that's all the work. I love this framework for doing it.
And Ross, you bring up another point, and Bijay, you talked about it also, and that is empathy. And the company, they look towards the CFO to kind of get a read on how the company is doing, and so I think it's important to talk about being smart, but also be positive in terms of how the company is going. Like Ross said, nothing has really changed yet, and if the fundamentals of the company are strong, really just make sure that you're setting a tone of just being smart, as opposed to, oh, the sky is falling, things are bad, the economy, the recession's coming, and because that will lead, it will be distracting, could lead to attrition of your best people. And so I think it's important as a finance leader to set a tone that is empathetic, to the situation, but also positive. And I'm very aware that as we have our all hands meetings, I'm always positive, always upbeat. And I think that's really an important perspective, a disposition to have as we, talk to the company, and just to keep, and same with, because that leads to discussions with, customers and board members. It's important that everyone has confidence in the company, and that can easily be lost in the current situation.
Yeah, totally agree, especially in a remote first environment. I think that communication, you may even need to do more than you would otherwise in an office setting. So totally agree there.
It also generates unique ideas. Jervis, we had a company that we were having, as you said, like a very comfortable conversation about how the world had changed, but our business was doing well. And one of the questions that came up just yesterday was someone asked, like, well, they sell to a lot of Series B and C companies that are going through that analysis of turning down software companies or software spend. And it was actually the head of customers, head of support, who said, like, well, why don't we go to our existing customers that we would worry about them doing that? And instead of just kind of hoping it doesn't happen, we'll go out and we'll go try and get them to actually sign multi-year deals ahead, because we'll get data. Are they nervous or not? Are they nervous about budgets? And I just got the report from them this morning, and it made basically everybody feel better. It didn't improve the stock market, but like everything that was coming back was like, oh no, we're definitely, we allocated, a couple of people committed, a couple of things did also turn up, but like, we're nervous, here's what's going on with our business. But it all came because the CEO was doing such a clear job of explaining what they were doing. And then the team went and found this very thoughtful thing to go do that, again, Beach, to your point, like people could then organize around, go do, and it's not, bail the water, we're going down. It's like, oh, this is the problem. Here's how we're tackling the problem. We're doing it as a team. Like, it was really, really savvy.
Yeah. And that's another great point, is our customers are going through the same exercise, right? And so, and this is an opportunity for us as a vendor to show how our product helps them achieve efficiency. Like we're in workforce management, and so our products definitely it can reduce attrition, it can optimize labor, and so we're really kind of punching on these points with our customers. So that's another, just a really important aspect is to take the value of your company and use this as opportunity to show how it can add value in this storm.
Last point on this one, Ross, I really love that anecdote. I think one of the things from a CEO's lens, looking beyond the data that I've been spending a lot of time doing is trying to really put out feelers across different parts of the org and see how the market is reacting. So spending a lot of time watching gong calls on the CS side. What are our customers saying? How are they feeling? How are they being impacted? Spending a lot of time talking to our outbound team. What are they seeing? Are we getting meetings? Are folks wanting to push them off? And then of course, spending time with marketing and sales on the go-to-market side. What is the market saying? How are they reacting? And really just trying to kind of, again, move beyond the numbers and get a more qualitative sense of how are folks day-to-day is being impacted by the market and the environment.
This is when we start planning this out, I kind of knew, because it's an angle that we talk about a lot, is this empathetic or like strategic finance partner. And I didn't know we'd kind of go off on it like this, but this is really great. I really love hearing how you all approach the company at large, and even from a finance seat, how you can sort of translate those numbers into something that is more impactful to the business. And it's why I kind of want to roll into our next topic, which is really, yes, we want to be empathetic. Yes, you want to be getting to the why behind the numbers, but you need to understand what the numbers are, what numbers matter first. And so, there was this, if anyone on here has seen it, there's been a lot of content about market downturn, but it was this Craft Ventures presentation. They had this kind of grid of the 5 metrics that really matter right now. It was like growth, CAC payback, gross margins, burn multiple, and net dollar retention. And so, Jervis, I want to throw this to you, and I want to know if like that list resonates with you, and maybe like what you're focusing on numbers wise, so that you can do everything you were just talking about in the previous section, so you can be that empathetic strategic partner.
Yes, definitely. Those numbers, as a SaaS company, they definitely resonate with me. And so, we're definitely looking at CAC and how much we're investing in sales and marketing to get new ARR. And we're looking at cash burn. I look at it weekly, and also I look at collections, and because at the end of the day, cash is king. And so we look at our AR, and we look at every single customer, and if there's an issue going, try to figure out what's happening there, and really make sure that we're being aggressive in collections. And so yes, there are, and just overall, yes, cash conversion also is another important metric. How fast are we converting cash into revenue? So yes, I mean, for us, these metrics are all very important. As I mentioned earlier, I have my Mosaic dashboard, and I can see all this data in real time. And my CEO also has access to this same dashboard, and maybe in the future my board will too, Ross.
Oh, I love that. Beej, any thoughts on the same thing from the CEO's perspective? Like how often are you looking at these metrics? I know you have a finance background, so maybe more often than the average CEO, but curious what you think.
Maybe a little more often, definitely in there. And I think, again, that real-time nature is quite nice. Sometimes I'm having a conversation with someone, I just want to pop in and get those real-time answers rather than have to wait days for someone to pull together a spreadsheet or whatnot. So having things be self-serve is definitely big for me and gives me peace of mind as a CEO. And Jarvis, I really love what you were saying, going back to some of that operational efficiency, right? You're billing your customers. How can we dial in our AR process? How do we make sure that we're invoicing everyone, we're collecting on time? Potentially, if you're paying in invoices early, stretching out AP. Not saying you shouldn't pay your vendors or anything like that, but those are the small little things that actually will help you in the long run. And that's I love to hear things like that.
I think a big part of it, and I suspect everybody on the call is already just wired this way, is the changing world of the role of the CFO, really from previous years looking back, of like, I'm reporting, here's what happened, here's where we spent money, to all the comments, particularly Jervis, you've been making around leading with a strategic point of view. Like, I'm bringing math, and I'm bringing math, and my real-time system shows me this week, not last quarter. And like, here's what's going on, so that you can make a change in spend, or you can, have everybody stare at a set of pipeline conversion data, and you can drive actually a really productive conversation, because you can show the data all pulled together real time and integrated with, like, top line, bottom line stuff together. That's just a huge shift from my experience of our CFOs that were back-footed and were incredibly powerful, but not always relevant in the day-to-day. I think it's a massive thing, obviously, that you guys do, but also, like, it's enabled because of the data being pulled together through people's hard work, Mosaic, and that kind of mindset.
Yeah, it's a really good point, Ross. I think when I think about our business, the expense side is fairly known, right? As a SaaS company, most of our expenses are going to be driven by head or variable per head cost. So feel like we can predict those quite accurately. And really, when I'm looking at my Mosaic dashboards, it is those numbers that will project something out to the future. So feel right now, what are those marketing metrics? What are some of those top of funnel metrics? And not what does it mean for June? It's actually, what is that going to mean for our Q3 ARR? So where possible, getting the right sensors in place to be able to start to peer into the future. If you're only looking at things at the end of the month that tell you about last month, that's not really strategic. It's a little less valuable than being able to have visibility into what the future might look like.
Yeah, we did. I remember during March, at the very start of COVID, so world's ending really bad. We're a big investor in this incredible company called Bluecore, it's an e-commerce company. It's probably, if you ever got an email like, hey, you left this in your shopping cart, do you want to buy it from Lululemon or whoever? You probably got it from Bluecore. And interestingly, they ran a really tight enterprise sales deal review because they didn't want to lose the world's largest commerce vendors with all the trim back of spend. And so the CFO, head of sales, and their AEs. And what they would do is the punchline is they end up going to all these companies looking at, the spend tracking. And they had a rose-colored example. They ended up going to these people saying, like, you're spending like, $4 million on Oracle. Don't cut back our, whatever, couple hundred spend. Instead, give us more. We will do everything Oracle does for you for cheaper. And it had a huge success. Now, that was all the right opportunity and hardworking AEs and all that stuff, but it came from the fact that the head of sales and the CFO were working together to say, okay, I need to better understand, are we going to keep and land these enterprise deals? And then ended up turning up this nice sales thing. But it's huge credit to that executive team that was doing that strategic work. Again, in this case, just asking the question and engaging and saying, hey, we all want to understand this number better, because we want to know if it's not working, we should bring the spend down and plan for that spend to change. If it is going to work, hey, maybe this is a place we invest in because it's going to show us a benefit. Again, maybe not this week, maybe it's, in Q1. And as Jervis said, well, that's when we're fundraising, so that's okay, as long as it shows up then. But again, that strategic leadership that you can uniquely do because you've got the data.
Right.
I know, one of these days we're going to do one of these webinars. It's going to be just an entire metrics webinar, because there are a bunch of follow-up questions I could probably ask about digging deeper, a lot of tactical examples about, Jervis's collections and how he's going to do anything like with those numbers. But we'll get to that another day, because I got to keep us on track. So we're going to jump. I know the big point here was that you're not just looking at the numbers to say what happened in the past, but really so you can look at what's going to happen in the future and get ahead of that. And I think that really leads us into this last topic we have. And it's kind of a pillar of getting through this economic storm, I guess, like depending on how bad it gets, but it's really scenario planning and trying to like build scenarios for your business to figure out how you're going to get through the other side and what that might look like. And so, Jervis, I'll toss it to you. And I'm just curious, like, how is Legion thinking about scenario planning now? Is it any different than it was, 6 months ago when you first started the year and things looked a little brighter? How are you handling this?
Yeah, so definitely from a planning standpoint, things are different. And so typically we have an annual plan. We're in a fiscal year, September 30th. And so we start that process around July or late June. And but given the current situation, we did another plan just a couple months ago, and just went through and sharpened our pencils. And the main thing we did is we were more conservative on some of our assumptions. So assumptions around revenue, assumptions around collections. We actually scaled back on future headcount growth, and the end result was like, where does that put us in terms of runway, right? And so, and the goal was to have a certain amount of runway based on a more conservative plan. And so that planning happened again about a month or so ago, and we'll start our annual planning process in about a month. But we constantly forecast monthly against that plan. Like, how are we doing? Just in the May. How does May look versus the plan that I just put together? And so planning is a constant. It's a constant exercise, and forecasting against that plan is, because what you want to do is, if we see things are off track, be able to make adjustments like on the fly, right? And so having that data and be able to make adjustments immediately is really important.
Yeah. And Jervis, I think you make a really good point, and we're kind of doing the same, right? You don't want to be surprised. So maybe last year, hey, we had this really big growth number. That's what we're shooting for. And if we end slightly below that, that's okay. But I think in this new world, being a little more conservative with the assumptions, really planning for kind of worst case scenarios. And then if there's going to be a surprise, the surprise is going to be on the upside. Hey, we grew more than we thought. We spent less than we thought. I think, again, you start to lose that optionality when your plan is, hey, things are going to go up into the right or whatnot. So just really stress testing those assumptions. And for us, it means being more conservative, running different scenarios and planning on a more frequent basis. So tough to do if you don't have a tool like a Mosaic, given that there's only one Jervis and there's 24 hours in a day. I really recommend leaning into some sort of a solution, Mosaic or others, to save yourself the time to be able to execute on all this work that's so crucial.
Yeah, I have two things that I want to reiterate. Like, I actually don't understand how you do this job if you don't have Mosaic or something very similar. I literally don't get how you're going to have a conversation where you're not going to surprise your board, your exec team. Like, it's like it is the topic of every single phone call. It's like, what do we have revenue wise? What do we think we're spending on? Where are we going? So it's, yeah, or maybe I'm sympathetic with those that don't. The second thing that I would say is building on Bij's, your comments, is mostly it's you are making investments that you need to pan out over time. And I think, Jervis, you said this well. My view is like, you can't just have linear growth. Like, okay, we just can't hire our sales rep, they perform at this rate, and therefore we're going to get these expected dollars. A lot of the investment is you're trying to create these spend less and create non-linear examples. What's something we could do this year that's going to generate a bunch of leads next year? Or we're going to actually spend a bunch of money on a new CMO. We're going to keep their staff relatively small, but again, we have this theory about that performance later. Or same thing, another company of mine just hiring two sales support engineers because they think it's going to accelerate their existing 15 sales reps to do more. But again, it's spend now. So these are all things where, like, again, you're the higher risk is of spending more dollars, but you're trying to get this outcome later, and they're clearly chained together, and then you're clearly like watching those numbers and saying, is this happening or not? So I just don't know how you do it without a tool like this.
Right. And I think you also need to be, we're trying to be strategic about where we're placing our bets from an engineering standpoint, right? So we have our kind of our core business that drives most of our revenue. And then we have our futures, right? And so we can look at it really on a portfolio basis, look at one product at a time. Like if I invest in this product, what's the ROI from an ARR standpoint? And really look at it and make decisions based on that. And maybe before you invest in a really cool feature that may not produce revenue for 2 years. But now in today's environment, we're looking for investments that yield revenue in the near term. If you kind of go back to how important revenue is from a multiple evaluation standpoint. And so we're looking to maximize revenue with investments that we're making today.
Love all this. Again, we're gonna keep us on track. I know there's some questions that came in that I want to get to. So this is really like the last main topic we had. And I think you guys did a great job just kind of like walking through what all this means. I love how each topic really ties together. And I think the points you all make are really great. I think there's a lot of value here. But like I said, I do want to get to some of the questions. So I apologize to everyone. I'm going to be looking to the side because that's where the questions are and I got to find them. There's one comment I want to call out. Jeffrey said, so Joe, you were saying we need more accountants and finance experts to look at the spend. Love it. I am not going to tell anybody what to do because I work in marketing, but from what I've heard, you all should hire sooner than you think you should. That's what the gist that I get from most finance expert is. So not going to address that question with you all, but there's a much better question here about how are you dealing with inflation in the SaaS environment overall?
Yeah.
Particularly when it comes to compensation and benefits. How do you grow in an inflationary marketplace? Jervis, you want to
Yeah, sure. And I think it's really important, I mentioned this earlier, is taking care of the people that are on board now and realizing that inflation is a real, has a real impact on families, right? And so one thing we've done is like we have our merit, our annual merit process. We just went through our performance reviews and which results in merit increases and promotions. And that was not on the table as an area to reduce. I mean, that's, it's important that, we, that the workforce is motivated, that they are not distracted by life and not distracted by looking for another job. And so we are dealing with inflation by taking care of our team.
That's a great point. I think I would get everybody's input here, but then we will absolutely run long. So I'm gonna keep rolling because I think there's another question here that I'm gonna direct to you, Ross, if you want to.
Jervis, I was gonna make one quick comment. Just I think that's consistent. It's consistent in venture-backed companies. People are not saying, hey, how about we buy everybody, a car and a private helicopter. But I think generally speaking, people are keeping their benefits and spend the same, if not spending a little bit more. I like your phrasing of like take care of the people that you're there with, because ultimately, relative to Bij's matrix again, it's on the margins, like the dollars you're spending relative to what you're trying to do with the business. Unless you're deeply wounded, and if you're deeply wounded, you probably need to make bigger cuts, bigger shifts.
Right.
Be a different business.
Right.
Probably.
That's exactly right.
Sorry, Joe, didn't mean to cut you off. I think that this question's coming up a lot from our companies because people are they don't want to be foolish. Who wants to provide a benefit while you're telling everybody to trim back? And again, this is the analysis people are coming to as well. This 401k matching matters, this support of this, whatever. So
Ross, you're free to cut me off whenever you want. They're here to listen to you.
We're here for you.
Jeffrey's here for me. Jeffrey's here for me to tell me to hire more finance people. But I'll
your raise. That's a takeaway.
I'll stick with you for this one because this is specifically about kind of the market at large. It's from Gavin. Do you think later stage companies are more at risk versus earlier stage A and B deals? he's starting to see these bigger companies doing layoffs and things like that. So what are your thoughts there?
The real answer is it just completely depends. I'll just tell you the venture universe. I was talking to a friend of mine that runs a big growth. He runs a big growth group for Index, and he runs that growth group. He's a wonderful guy, and he was saying how they're out looking for things that they missed or they couldn't get into previously, and they want to put more money in because they think, again, the same mentality. Those things are going to end up winning. Whatever the stripes or checkouts or pick a late stage thing in the world are going to end up in a stronger place, and they've got lots of capital. So and similar in the early stage, the Mosaics and Legions of the world are growing. There's growing smarter, all that stuff. So I think it depends a lot on the business. And the details. I mean, on absolute dollars, an absolute number of people, the bigger ones are going to cut more folks, period. But we all see it in LinkedIn for every, Stitch Fix. It's sadly laying off people. There's, folks piling in saying we're hiring good folks. So I think it depends a lot. And on the business, on the businesses. The one thing I would say is make sure that your role is highly valued. And that might even be if you're in an org and you're worried about it, not because you're an underperformer, but because, hey, there are a lot of us doing the same job. And, you can imagine Jervis starting rolling that analysis. Maybe it's the time to look at where can I go do that great work somewhere that needs this versus don't. But that's a real, devil in details kind of view.
For sure. I think
it's also the press. Press is going to love talking about this. People love loving stuff when it's going up and it's great. It's going to be huge. And when it's going down, they get the clicks by writing about how it's all cratering and some of it's dumb. And come on, we all knew this or that company was dumb, valuation or not. So I think the press can be misleading. We're all living more like humans. You or your partner's job feel good.
Fair. As somebody who writes for a living, I can empathize with the doing it for the clicks, but I don't work in the press, so it's not quite the same. I'm gonna ask one last question before we do wrap up, and it's not here, but it's something that was on my mind while I was kind of creating the outline for all of you. And Bij, I'll direct it to you. I'm curious, and maybe the answer is no, but we have that kind of list of what the main metrics are that kind of Kraft was looking at. We talked a lot about metrics. Are there any that are under the radar metrics that you pay attention to that not a lot of people talk about that kind of helps you look at the business? It could be specific to a department or something. I'm curious if there's a standout metric I haven't heard of or I don't get a lot of attention to.
Yeah. I'm gonna answer a slightly different question, which is I don't know if there's necessarily one North Star, right? It's gonna be different metrics for every company, but I think what gives me peace of mind is actually the breadth and depth that I can go into. I don't know if you're going to be able to look at one metric and it's a silver bullet, but it's more, how do I really start to explore kind of the nooks and crannies across the business and make sure that I'm not missing anything? So I think it's actually being able to go wide and deep. And when there's a question that I have, knowing that I can quickly get those answers and that I trust the data is probably more important to me than one individual metric that's going to make or break the company per se.
Cool. Love that answer. Well, I'm gonna kind of roll into wrap up here, guys, because we have a few minutes left, and I'll let people. I don't want to get too up against the end. Just want to say thank you to everybody for joining. Wanted to give a shout out because there's been some references to Mosaic dashboards and things like that, but we talked a lot about real time access to metrics mattering most. And wanted to give everyone a heads up. We added this new template in the in the platform. Operational efficiency template includes things like your quick ratio, your magic number, and also the two new metrics that have kind of become the big focal points here, which is burn multiple and cash conversion score, capital efficiency. So I wanted to give everyone a heads up that we have this. I'm going to launch a poll. If anyone wants more information, we can reach out to you. And then the other thing is agile scenario planning, and really. It's kind of bread and butter for what we do here, which is kind of duplicating models, creating what if scenarios that you can do on the fly, and doing everything that Bij and Jervis and Ross had talked about, which is really getting a clear view of how different assumptions are going to impact your business. So I'm not going to harp on the hard sell for anybody, but wanted to give a heads up that there's a lot going on in the platform that specifically addresses kind of what we talked about today. And so would love to kind of talk to anyone that wants to hear more. So be sure to answer the poll, reach out if you want more. We have a lot of additional content that we can follow up with as well if you're not ready for making a purchase. But yeah, would love to hear from everyone. Got the About Mosaic slide. Check out connect with Beej, connect with Ross, connect with Jervis. Be sure to connect with everybody. But again, just want to say thank you, Beej, thank you, Ross, thank you, Jervis, for chatting with me today. I really appreciate all the insight that you guys give. I think everybody here appreciates the insight. Any closing thoughts from any of you before I hit end here?
Thanks for hosting. And yeah, we'd love to chat with anyone that's got things on their mind. I'd be more than happy to be a resource. So feel free to reach out on LinkedIn and would love to chat.
Yeah, likewise, connect with me at LinkedIn, and I'm definitely open to talking about anything from finance, HR, IT.
And the
things that keep me
Celtics,
up
right,
at night.
Jervis? You're right. You're ready to chat about the Celtics.
And the Warriors.
Oh, okay.
Okay.
All right, cool. Well, thank you guys so much, and we'll do this again soon. Thanks again.
Thanks, Joe.
All right.
Bye,
All
everybody.
right.